Okay, everybody, we're going to get started now. This is Michael Kimmel, Executive Director of the Reform Pension Board, and I'm going to turn it over to Len Teitelbaum, Chair of our board, for some opening remarks.
Thank you, Michael, and good afternoon, and welcome to our 11th webinar, and it's the first quarter of 2019 webinar for those who are looking in the archive. This continues our effort to update you on our current thinking and help educate those who may need it on our investment philosophy. On the update portion, I'd like to remind you that at the end of 2018, your RPB instituted a Roth 403B plan, a loan program, and importantly, I think, the ability of congregations to invest directly in our precedent-setting Jewish Values Investment Fund. As you know, this is a key part of the plan and really precedent-setting, as I said. We are also continuing to review all aspects of your plan regarding vendors and consultants to ensure we're providing the best service to you. I will have more to say about this in my chairman's letter, which you should be receiving shortly. A bit of history, if you please. In 1967, I began to work full-time in the investment business, and to be sure, things were astoundingly different. The money center banks, one of which I worked at, were the largest factor in the institutional market, and Vanguard and Fidelity were just gearing up. The investable choices were comparatively few, and the advent of the REIT was groundbreaking. Options were controlled by one firm, and chartists were not to be trusted. It was truly a market of stocks and not a stock market. In spite of the dramatic changes from then until now, there was one constant: volatility. Now, it seemed like each decade something negative happened. It came in various appellations and reasons. Some of you will remember the So's bandits, program trading, tech bubble, and a lot of phrases that I choose not to use. Call it what you will, it all had the same effect. Everyone took a hit and contributed it to volatility. Now, as you listen to our presentation today, please pay particular attention to this recurring theme. Also, you will note in one of the slides that when we array our Tier 1 portfolio, the cash reservation is on the extreme right, which has the least volatility, and reading in Hebrew to the left progresses to the most. Please keep that in mind. Now, let me close with a short example I used when I had to teach a class. Updated, of course, for current thinking. What does a $25 stock dropping to $24.75, or a $50 stock dropping to $49.50, and a 235-point drop in the Dow Jones have in common? Again, $25 stock dropping to $24.75, a $50 stock dropping to $49.50, and a 235-point drop in the Dow. What does it have in common? They are all down 1%. Our worry quotient, however, does vary indeed and dramatically. Now, before I turn the microphone over, I would like to thank Stephanie Berger and, of course, Michael for their invaluable assistance in helping prepare this webinar. I hope you're finding it of interest, and I hope we're touching on the points that we hear back from you that are most important to you. Remember, we work for you. Michael, I would now like to turn the microphone back to you to start the presentation.
Thank you, Len. I'd like to extend my own welcome to the 218 participants registered for today's call. Before I turn it over to David Baskin, Chair of our Investment Committee and also President and Founder of Baskin Wealth Management, just a few housekeeping items. First, as always, this webinar is being recorded and will be posted to our website in a few days. We'll also email a link to all of those who registered. Regarding questions, thanks to those who submitted those in advance. We will address them at the end of the session, as well as those submitted during the session, which you can do by clicking on the Q&A button found at the bottom of your screen. This can be done anytime throughout the presentation. Now, one more thing before I turn over to David. Just briefly want to review the agenda. You have already heard the opening remarks from Len. David will then take over and go through a market recap as well as an update on the plan, as well as get into looking ahead into 2019 on the economic and markets. And then we'll wrap up with the session on Q&A, and we'll go from there. Like I said, submit your questions anytime by clicking on the Q&A button at the bottom, and we will get started. So with that, I turn it over to David Baskin. David?
Thank you very much, Michael, and welcome to all participants today. As always, I'm going to try and make this presentation as user-friendly as possible, recognizing that most of us are not professional market participants and have other day jobs. So let me start by saying that 2018 was the most challenging year and disappointing from an investment standpoint that we've had in a decade. It was certainly the worst performance by the public markets since 2008 and 9, which we probably all remember due to the scars we still bear. Almost every asset class had a negative return. The only stock market in the world that made money was the Jamaican stock market. And let me say, we were not big investors in Jamaica. Every asset class, with the exception of short, and by short I mean less than 6-month treasury bills and certificates of deposit, lost money. So really the only way to win the game in 2018 was basically to refuse to play, to keep your money on the sidelines. Let me say this doesn't happen very often. The last time that short deposits was the best asset class was 1994, about 24 years ago. And that's about how often that this happens. About once every couple of decades, cash is the winning asset class. So it's not a sign that we should sell everything and run to cash, because my expectation is it may not happen again for another 24 years, but you never know. So why did everything do so badly in 2018? What made it different from the terrific market returns we had in 2017? And in fact, the pretty good market returns we had in the first 3 quarters of 2018. I think it was a combination of things. And what we're going to do is we're going to go through a number of factors, what I would call a play in 4 acts, by looking at the return to volatility that happened during 2018. I'd like to remind the participants that 2017 was the least volatile market in the history of the US stock market. The number of days in which the market gained or lost more than 1%, much less 2%, was at a record low. The markets were incredibly passive and generally moving in an upward direction. During 2018, the theme that we saw was the return of volatility, and nowhere did we see this more than in December, and in particularly in the 2 weeks leading up to Christmas Eve, the 2 weeks from December 10th to December 24th. So if you look at the chart that Michael's put up on the screen, you can see that during the first 9 months of the year, things were quite calm. We had the first major dip in the start of the year in January. And this is when it became clear that the chairman of the Federal Reserve Bank, Powell, was going to increase interest rates and probably increase them quite substantially. The market had grown fat on very, very low interest rates. This had two important effects. Number one, it made bonds unattractive as an asset category. Why invest in 10-year bonds that are paying 2%? Not a way to get rich. And it also made it inexpensive for people to buy money, that is to say, to pay interest in order to invest in stocks, invest in plant and equipment, buy houses, buy trucks, buy cars. When money becomes more expensive, all of those sectors are going to cool off, which is why when there is a worry about inflation, the Federal Reserve does that. So the magenta box says markets begin to price in rate hikes, which scares the equity markets. The next box, the orange box, really is the story of the summer. Now, as a Canadian, I'm trying not to be overly critical of my neighbor to the south. But let me say that from an objective standpoint, the American economy is less dependent on trade than most countries in Europe, certainly less dependent than Canada or Mexico. But nonetheless, a full 25% of the American economy is dependent on trade. And therefore, most economists would consider it to be a self-inflicted wound to enter into trade wars with one's three largest trade partners. In the case of the United States, that being Canada, Mexico, and China. Nonetheless, that is exactly what the United States did, in part by imposing tariffs on goods imported from China and from Canada. Canada is still suffering tariffs on steel and aluminum, and on goods from Mexico, and by threatening to rescind long-standing trade agreements, in the case of Canada, Mexico, the North American Free Trade Agreement. The impact on this was felt in the economy. For example, the export of American soybeans to China, which had previously been the biggest customer for Midwestern farmers, fell to zero in November. But also had an impact on manufacturing taking place in the United States. General Motors in the third quarter, for example, said that its cost of steel had risen by $1 billion for the quarter because of tariffs. The market became increasingly concerned that the combination of higher interest rates and trade wars might act together to cause a recession. But nonetheless, you can see that during the summer months, the market stayed relatively calm, and in fact reached a high at the end of September. This was driven largely by excellent corporate profits and very low unemployment all over North America, but particularly in the United States. At the end of the day, stock prices largely follow corporate profits, and corporate profits that were reported in the second and third quarter of 2018 were at record highs. Stock prices followed. So what happened to cause the market to crater in the fourth quarter of 2018? What was different? And you can see a very sharp fall in September and October, followed by the two-week period that I had already mentioned in mid-December. Well, number one, the Fed raised rates again at its meeting in the fall, and said that it would likely raise rates 2 more times, at least in 2018, and as many as 4 times in 2019. This really caused mayhem in the bond market, with bond prices selling off sharply. Bonds prices go down when interest rates go up. The bond market's much bigger than the stock market. That had a big impact. This was exacerbated by the Treasury of the United States unwinding its quantitative easing program, which it had put in place following the great financial crisis. The Treasury owned $4 trillion worth of bonds and was selling them into the market. The effect of these two moves on the short end from the Federal Reserve and on the long end by Treasury was to increase interest rates across the board. And the market, the equity market, signaled its displeasure in rather decisive terms. Finally, in the end of the year, we started seeing concerns that the American economy might in fact enter into a recession. And the bellwethers, the sectors that raised the most concern, were new housing starts, sale of existing homes, and particularly sales of automobiles. In spite of very low prices for gasoline, which is normally a spur for car sales, we in fact saw the major auto manufacturers selling fewer cars. While we would expect there to be a large number of housing starts at this time in the economic cycle, in fact, we saw the opposite. We saw a drop in housing starts and a fall in the number of existing homes being resold. This made people very nervous, and when people get nervous, they sell stuff, and we can see what happened towards the end of the year. In the last 2 weeks, going up to Christmas Eve, the NASDAQ was down, I believe, something like 11%, and the S&P 500, a broader index, I believe, lost 7% in those 10 trading sessions. That's a pretty sharp drop indeed. Now, you can see that at the very end of the year, and in fact, in the first 2 weeks of January, we've seen a nice bounce back. but that won't impact your statement for the fourth quarter of 2018. So Michael, if we could move along to the quilt. We call this slide the quilt for obvious reasons. This chart basically shows you the returns on the different classes of assets into which you can invest your money, in this case over a full 18-year period. Very appropriate for a rabbinic pension plan. And what you can see that in the very top right-hand corner, the bright blue under 2018, that's our stable value product. That's our very short-term guaranteed, really certificate of deposit plan. That's returning a 1.9%, and that's the only positive asset class for 2018. As you read down the 2018 line, you can see that bonds broke even, that high yield bonds, that is money lent to higher risk organizations, lost around 2%, that real estate investment trusts lost almost 5%, that US equities, a core component of almost every component of every portfolio, lost over 5%. Master limited partnerships, a specialized asset class that is heavily tied to the oil and gas industry, minus 12. Developed market stocks outside of North America, almost 14%, and emerging market stocks, which includes places like China, India, Russia, Brazil, almost 15% down. In other words, a pretty lousy year. And the column just to the right of that shows you the fourth quarter, and you can see that stocks were really lousy in the fourth quarter, with US equities down 14% in the fourth quarter. The question that naturally arises, and I'm going to discuss this in about 10 minutes, is past prelude. In other words, can we make any assumption about what's going to happen in 2019 from what happened in 2018? And the whole point of the quilt is to show that no, past is not prelude. If that were the case, you would have solid bars of the same color marching from left to right. But what you see is that, in fact, the market leader one year, in 2018 emerging markets, for example, 2017 emerging markets, was the worst asset class in 2018. And that real estate investment trusts, the best asset class in 2015, was near the middle in 2018. In other words, it's very difficult to make an assumption about the performance of asset classes from what they did in any given year. If it was easy, then we'd just put all our money into that asset class and leave it there. But sadly, it's not that easy. So I now want to talk about what actually happened to our various tier one investment products in 2018. Capital appreciation is the product that we manage for growth. It's supposed to provide the means by which your savings will grow faster than inflation, so that your retirement funds will be larger than they would be if they were in a passive product. You can see through the green line on the far left of the chart that our capital appreciation product was down about 8.25% in 2018. This compares to its benchmark, which was down more than 10%. I'm going to talk about this more in a minute, but our managed products are designed to be more conservative than the market, and in a down market to capture less of the downside than the market index. And that's what happened both for the capital appreciation product and for the appreciation in income product, the product that combines growth with fixed income to provide a more stable return, which itself was down 4.9% during the year, but outperformed the index by about 0.5%. The income-focused fund, very conservative bonds only, lost money, and you can see that the bond market was exactly flat for the year. And the only product that made money, as I talked to about before, the stable value, the capital preservation fund, the most conservative product imaginable, for the first time in 25 years, led all the other products with a positive return of 1.93%. This is not an attractive return. Nobody brags about losing money. I can tell you that as a professional money manager. But we did take certain steps. And Michael, if you can switch to the next slide. Your investment committee was aware in the summer and the early fall that stock prices looked extended. So we did take some money off the table. We put it into cash. That cash was redeployed in December at much lower prices in both capital appreciation and income. We got out of the energy business. We sold our holdings in the master limited partnerships, and we changed that to more diversified exposure to infrastructure that has a high yield characteristic that will pay good dividends, but is much less exposed to energy. We think that both of these moves will have a positive impact going forward. Next slide, please. We've talked before on these seminars about the concept of upside capture and downside capture. If the market goes down 10% and our pure equity fund goes down 8.5%, we've captured 85% of the downside. If it goes up 10% and we go up 9%, then we've captured 9% of the upside. What we're trying to do is protect money in the down market, which we did this year, and the price we pay for that is sometimes underperforming in an up market. Without getting too technical, I want to go very quickly through 4 basic metrics. So Michael, if we can see the standard deviation slide. Standard deviation is a measure of how volatile stocks are. Lower standard deviation is better. It's a proxy for risk. It's a way that managers look at how risky a portfolio might be over time. And you can see that in all 3 of our managed products, our standard deviation is less than the benchmark, meaning that we're taking somewhat less risk than the benchmark. That's what we're supposed to do. On the next slide, another way to talk about risk is so-called beta. Beta measures how volatile any given security or group of securities is compared to its benchmark. Our stocks are only 90% as volatile as the market. Our appreciation and income beta is closer to the benchmark, and that's because bonds generally are not that differentiated in terms of risk, and that brings the volatility closer to the benchmark. And our income-focused beta is much lower because of the nature of the products that we hold in there. So we're taking less risk in our managed products than the market. Michael, the final slide, again, without getting too technical, Sharpe ratio is a number that's calculated by looking at return divided by risk. If we have the same return as another product, but we're taking less risk, then our Sharpe ratio is higher. And obviously we want a higher Sharpe ratio. You can see that we have very slightly higher Sharpe ratios than our benchmarks. Basically, we're getting a slightly better return and taking slightly less risk. Finally, in terms of these economic measures, the upside and downside capture that I referred to, you can see that our down market capture and capital appreciation was about 89%, less than the market. Similarly, in appreciation and income, we captured 94% of the downside, more than I would like, but better than capturing 100%. And finally, in income focused, we only captured 50% of the downside. Although I have to tell you, in income focused, we're talking relatively small differences because of the nature of the bond market. So that's tier 1, which comprises about 90% of the money that our participants have invested. Tier 2 are the do-it-yourself options that we'd offered for the last 2 years, which give investors the chance to basically select their own passive products that have lower management fees, typically management fees as much as 0.75% lower than that in our managed products, and which therefore follow very closely the indices that they're designed to track. And as you can see, the various products, in fact, do track the indices very, very closely. The only difference essentially being the costs of those products. So, of course, for those who picked the S&P 500, they have a negative return more or less equal to the S&P 500, and similarly with the other products. Again, the only positive results in the tier 2 are the very short bonds, which have a very, very slight positive return. Everything else was negative to one extent or another. So that's what happened in 2018. And I guess one of the reasons we have a lot of participants on the call today is because people are interested in knowing what's going to happen in 2019. And let me be the first to say, I don't know. Nobody knows. All we can do is make our best estimate based on what we think should happen. And let me start by talking about political uncertainty. We now have in the United States a divided Congress, and we're starting to see with the extended government shutdown the effect that a divided Congress might have over the next 2 years, with a recalcitrant House, which apparently is not prepared to be bullied by the president, which may be reluctant to bring into legislation or into action things that the president wants to do. Again, markets don't like uncertainty. That can't be a help. Although there is a resolution of the trade deal between Canada, Mexico, and the United States on the table, that deal has to be legislated. It has to be passed by Congress. It hasn't been passed yet. And it's certainly the case that the US trade difficulties with China have not yet been resolved. And that's a daily drama with headlines in the financial press, and the likelihood of the United States and China making a comprehensive deal is incalculable, at least by me. On the other hand, we continue to see very solid employment numbers in the United States, no real sign of increasing unemployment, and perhaps except for the social justice warriors among us, no sign of wage inflation. One of the things that the Federal Reserve was very concerned about was that low unemployment in the United States would inevitably lead to higher wage gains, which would manifest themselves through higher consumer price inflation, which it doesn't want. We have not seen any sign of that, at least so far. In reaction to the very sharp market downturn at the end of the year, the Federal Reserve seems to have backed down from its expected rate hikes in 2019. But the Fed has said that it is data dependent. In other words, it's going to wait and look at the numbers. And in spite of pressure coming from the White House, it's certainly not beyond imagination that if we do start to see consumer price inflation and continued low unemployment, that we could see some interest rate increases in 2019. Again, the market might not like that very much. So we're seeing a disconnect between market performance and economic fundamentals. Corporate profits coming through so far appear to be very high. The economy seems to be doing pretty well. We don't see that many signs of economic distress, except for those problems I noted earlier in housing and some sectors of autos, but the market is not convinced. So will we have a recession in 2019? Again, nobody knows. We've had a very long time since the last recession. Almost an unprecedentedly long time. And if we could slip ahead, Michael, I'm going a little fast because I've used up too much time here. If you could go ahead 5 slides to the economic cycle beginning of the end slide. And by the way, all these slides are available on the website if I'm not mistaken. This slide, it's been 44 quarters since the last recession. And as you can see, that's the longest continuous expansion in the post-war period. How long can that go on? Nobody knows. It's the tendency of economists to think that that nothing goes on forever, and that eventually there'll be some event or a series of events which will cause the economy to slip into recession. And the very length of this expansion has people concerned.
David, question about that. If you were to look at your run-of-the-mill recession, what is the average length of those recessions?
Normally, somewhere on the order of 2 to 6 quarters. 6 quarters is a very long one, a year and a half. Probably the average is more like 3/4 of a year. And the depth of the recession, varies enormously. The downturn that we had in 2008, 2009 was the sharpest recession since the Great Depression of 80 years earlier. The last really bad recession before that was in 1981, when the Federal Reserve, in order to combat inflation that was running in double digits, sent interest rates up to the 20% range, caused employment to soar to 12% in the United States, and caused a very deep recession that lasted for about a year. So what do we do? If we look at all the evidence, we probably will see returns for the stocks markets that are less buoyant than the returns that we saw in the period from 2009 to 2017. To remind people, the S&P 500 bottomed out at about 660 in the spring of 2009, exactly 10 years ago, and proceeded to quadruple in that 10-year period. We're not going to see that happen again. What's a reasonable return for stock market in these conditions? Most people would probably say somewhere between 5 and 8% is not an unreasonable expectation for stocks.
But it also but that may not all happen this year.
No, of course not. We would like life to be linear. It would be so much easier if every year was like the year before. But as the chart at the bottom of this page shows, and I think this is a really important chart and a terrific one, to get to a 5.6% compounded rate of return over 20 years, you suffer a lot of ups and downs, more like a roller coaster than you might like. The red line shows that $1,000 invested in 1998, 20 years later, had grown to around $3,000, a 5.6% compounded return. But you can see by looking at when the blue line is above the red line, which is when the market is very strong, and when it's below the red line, which is when the market is weak, that it's not linear. You can have great years and bad years. 2018, we had a bad year. Previous years have been pretty good. I think the important thing here is that, particularly for younger participants who have a long time horizon, don't think that you can time the market. Don't pretend that you know what's going to happen next. The important thing, and I can't emphasize this too much, is time in the market rather than timing the market. The longer you stay in the market, the greater the chance that your actual returns will look more like the red line. If you try and time the market, the likelihood of you selling when you should be buying or buying when you should be selling is considerable. So for younger participants, stay the course. Time in the market is your friend. For older participants, understand that you don't have as much time to make up for bad returns, and therefore your asset allocation should be adjusted to meet your risk tolerance. The older we are, the more conservative we should become. That means generally more fixed income kinds of products and less stocks. And finally, and this is the last point on the slide, and also bears repeating, unless you keep putting money into your plan, you can't hope for the market to make up for the failure to contribute. The amounts that most economic professionals think that we need to put into our plans in order to duplicate the amount that we need for our lifestyle post-retirement is usually around 18% of pre-tax income. If we put that into our plans consistently over time, and the markets behave as they behaved more or less on average over the last 70 or so years in the post-war period, then we should be able to have income in retirement that's very similar to what we're spending pre-retirement. And that's what we talked about in our last webinar. So the 2 points that I want to end on before I take questions are, number one, time in the market, stay in the market. Number two, think about your asset allocation. Think about where you are in your retirement planning, or if you're already retired, where you are in the number of years in which you might need income, and think about adjusting your risk accordingly. But above all, if you're still working, even if you have a deal with your employer, that's a package deal that lets you choose whether you want to take salary or pension, more pension, less salary, more salary, less pension. Do the enforced savings, take more pension, take less salary. You can't make up for missed contributions by doing well in the market. Experience shows that just doesn't happen. So Michael, I went over 5 minutes, but we do have some questions, I know, and I think we're able to take questions that come into you over the internet. Is that correct?
That is correct. So before we get started with the questions, I just want to highlight a few resources for all our participants. For those who are approaching retirement or thinking about it, we have our upcoming retirement planning seminar from the 19th to the 21st of May in San Francisco. The registration is available on our website at rpb.org. Also want to mention our free resource from LifeWorks. And this is a resource that all participants, whether you're active, retired, or not contributing now, can participate in and utilize. And this is our financial counseling service, which provides counseling on investments and budgeting and saving for college and debt management and whatever other financial questions you may have. Just call the number, let them know you're from the Reform Pension Board, and they'll set you up with a counselor based on the subject you want to speak with them about. And then finally, I just want to point out the calculators that we have available on our website at rpb.org/calculators. So, excuse me, with that, we'll go through the questions. First, we'll review some of the questions that were submitted in advance, and then we'll get to the questions that I now see are starting to come in from you all now. So David, the first series of questions has to do with investment choices and asset classes. First question, and I think we kind of answered the question already through the presentation, but are there low-cost index funds available? If so, what are they?
So that's what our Tier 2 is. Tier 2 gives you the option to self-direct, pick your own mix of very low-cost investment alternatives, which includes U.S. stocks, international stocks, a number of fixed income alternatives. In all cases, the management expense ratios are very low indeed on these products. Are there any reasons not to choose a low-cost index fund? We think so. We think that we can get less downside capture, less risk, as we talked about, and we hope outperform the markets on a consistent basis, even though we're paying higher fees. And it also relieves you of the obligation to adjust your asset allocation quite so regularly, or to predict or choose what might be an optimal mix for you. So the reason we offer Tier 1 and Tier 2, we know that some people have outside financial advisors or spouses who have assets and they'd like to balance. Tier 2 gives that opportunity. As I say, 90% of our assets remain in Tier 1, which says to us that many of our participants prefer to have a managed product.
Thank you, David. One particular question, very specific question, does the RPB invest in preferred stock?
So we don't have an actual preferred stock manager, but our managers certainly have the opportunity from time to time to buy preferred stock. For those who don't know, preferred stocks generally offer high dividends and lower volatility.
Right, but we do not directly invest in.
No, we have no product that is directly preferred stocks.
Correct. Okay. Moving on to questions regarding allocations. These are all relative to being more conservative. So let me read them all, and then you can, answer them all at once. So, do you think we should be more conservative this time? Given the course correction, at what age should we be making more conservative retirement choices? I'm very worried about a recession and keeping any money in the market. You addressed it a little bit, but maybe you could expound on this idea.
Yeah. So every academic study I've read, and there's literally dozens of them, indicates that nobody's very good at timing the market. If we think that we can sell out of the market at an optimum time and put our money back in at an optimum time, we're kidding ourselves. Nobody's been able to do that consistently. There's every chance that you'll sell at the wrong time, and there's every chance that if a recession does come, you'll be too slow to get back into the market. The number of people who were really brilliant and sold in 2007 and 2008, and then sat on the sidelines for 5 years and missed the S&P 500 quadrupling, are certainly higher than the number who both got out at the right time and got back in at the same time. The wisdom that I've received through all my reading and by doing this for 27 years is that you're much better off leaving your money in the market, riding the ups and downs, capturing that curved red line we saw in the last graph, and rather than trying to get off the roller coaster when it's going down and get back on when it's going up. So for most people, and I'm talking primarily about people who are active participants still contributing, much better to be staying in the market, putting your contributions into the asset allocation that you've decided is optimum for you. For those who are in fact retired, given the course correction, at what age should we be making more conservative retirement choices? I can tell you that the sellers of what are called age-related funds generally differentiate the asset allocation on either a 5 or 10 year basis. In other words, they look at your age as a step function. If you're 55, 60, 65, 70, they generally adjust the allocation on a schedule like that, getting more conservative every step as one approaches retirement, and when one is in retirement, reducing the risk even further as the need for funds becomes shorter and shorter. So that's how that's done. I'm not allowed to give advice on that. I think that's something that you need to discuss with the resources available to you.
All right, thank you, David. And so I think you
Michael, I'd like to add, Michael, if I might, I'd like to add one thing. David touched on it, and I know, Michael, you've touched on it when you've been on the road. When you look at your portfolio and your assets, if your spouse or have other assets outside of the retirement fund, one of the advantages, hopefully, that LifeWorks will provide, and if they don't, we'd like to know about it, is you have to look at your entire portfolios holistically and in total, so that you don't overburden one fund as opposed to looking at all of your investable assets. How big or how small is obviously an individual case, but please make sure that you're looking at this in the correct way as you approach your retirement. Yes, you want your pension fund to provide X amount of money. We understand that. But I think when it comes to investing, until you get to that point, you really should look at all of your investments as a total, and how do you arrange your personal total portfolio.
Thank you, Len. So I'm just reviewing some of the other questions that were submitted, and I think David and Len both, I think we touched upon many of these through the commentary. So for example, one question is, I'm already retired and no longer contributing. How do I weather a possible recession when there aren't that many years to recoup? David, I believe you really answered that by talking about as you get older, the common wisdom is that you become more and more conservative in your investment allocation, so that you don't, the volatility of your portfolio isn't as great. Is that correct?
Right.
Okay, thank you.
And we should remember again, Michael, as we said earlier, as you look at the array that we have on the slide here, as you move to the right from the left, volatility should decrease.
Correct.
But I don't, okay, just so that we know that you don't want it to be a barbell, but definitely there is a mix in there that should result in your personal appetite and stomach for volatility.
Okay. Right. No. Absolutely. Absolutely. So I'm gonna go bounce back and forth with some of the questions that were submitted live here with what we've received in advance, because they're very similar. Again, I think we more or less addressed this. Please address the general kind of investments taken by retirees at age 76. Do you believe the appreciation in income fund would be appropriate for those in their mid-70s? My advisor tells me my age expectation will be in the 90s, God willing. So,
Michael, let me address this because this is a very important point,
yeah,
which I discuss with clients on a daily basis. When I started in this business, which is now a long time ago, The general theory was that we investment professionals should look at a client's age and subtract that from 100. So if a client was 70, we would say 100 minus 70 is 30, and 30% was the amount that would be in stocks. And therefore, when the client got to 80, it would be 20% in stocks and so forth. When I started in this business, people's life expectancy was 6 to 8 years less than it is now. And for the kind of people on this call, professionals, probably almost all of you are non-smokers. Many of you lead healthy lifestyles, albeit with too much stress. Your life expectancies are very high indeed. And for a married couple, the chances of one partner living into their 90s, if both partners are over 65, is about 70% right now. So money has to last longer. And with interest rates very low, and remember the bond yields that we saw, 2 to 2.5%, that may not get you there. So certainly what we're doing in our practice here is keeping people in more stocks later in life than we did 2 and 3 decades ago. And I believe that's probably advice you'll get from a lot of people.
Michael, you did an excellent study that you showed to the board. What was the average life expectancy beyond retirement? I don't know if you've got that information still in hand or not. Was it 20 years?
Oh yeah, I mean we were assuming 20 to 25 year.
Yep.
In the analysis we had done regarding retirement readiness, which was our last webinar, we assumed a 25 year, assuming 65. You retired at 65, you had a 25-year retirement, so 90 basically. The demographics certainly are in general in our participants' favor relative to the general population, but obviously each individual situation, family history, etc., certainly should factor into that. So go ahead.
I think that's important. Sorry, Mike. I think that's important for participants to recognize that the minute you turn 65 or 70 or whatever age you choose, things don't just stop and the withdrawals become one way. You still need to provide for a substantial amount of time. David said it. I started a little before David, I guess, and I can tell you that's absolutely how we used to run the portfolios, and David is 100% right. People are living longer, and their requirements from a financial point of view may actually increase in certain areas. So we ask you to look at this thing in a much more of a how does today look rather than how did yesterday look.
Excellent comments, Len. All right, so here's a slightly different question. During this time of extreme volatility, does it make sense to choose an option to stop regular updating of my asset allocation? And Len, before I let David or Len answer, just want to comment that in your account through Info Express, when you log on, you have the option to have your account automatically rebalance back to your selected or elected asset allocation across all our funds, or you could turn that off. I believe most people have it set to automatically rebalance, and that's on a quarterly basis back to those targets. But there is a school out there that says that maybe there are times at which one does not. So I'm going to let David and talk about that a little bit.
So one of the great things about making regular contributions and having automatic rebalancing is sometimes you're going to buy low, sometimes you're going to buy market, sometimes it may appear that you bought high, but if you do it consistently for a long period of time, you will have bought exactly at the right place. The lows will balance out with the highs. I can tell you that the chances of doing that by attempting to time the market and withhold contributions or hold them in cash until you think the market is cheap, your chances of doing better than doing it automatically are pretty low. I'm not going to say zero. There may be some geniuses out there who are going to be better than that, but I doubt it. There's a lot to be said for automatic rebalancing. Your December contributions will have gone in and you will have captured some stock prices at really excellent prices, very cheap. That will have made up for the ones you bought in August that now look to be too high. you do that over the years and it'll all average out.
Great, thank you, David. All right, I'm going to turn to some questions that folks have submitted online. First one is, are CDs a good investment now at nearly 3% for a year?
It depends who you are and what you're trying to achieve. I suppose if you're a retired participant and you're looking for a guaranteed income to finance your lifestyle, is not a bad thing. If you're a younger participant and you're looking for growth above inflation, bear in mind that inflation in the United States is slightly over 2%. So a 3% CD is giving you a real return of less than 1% a year. That's not going to grow your savings very fast. Over time, nothing outperforms the stock market. You pay for it with Cirrus.
Right.
If I could just add, be very careful in some of the CDs that you recognize that once you buy it, you cannot touch your money for a prescribed period of time. Should you decide you need to cash in a CD, please look at a penalty clause because the interest rate could come crashing down on you. I'm not saying this happens in every case, but in every case, the money is locked up for a period of time. Some are short-term. Most of the attractive rates are longer-term. Please look at it as an investment over that prescribed period of time. This is not to say they're not good investments, but please recognize that there may be some personal limitations by you on how you put your money in as opposed to something else.
Thank you, Len. And of course, the CDs, you can buy those on your own from your bank. We do not offer them within the RPB. All right, next question has to do with the retirement seminar being held in May, that it's a challenging time for some congregational rabbis as well as educators. And the question is about moving it to a different time of year. Let me take this one. This is something we've looked at. It's been, I know it's a challenge for some. The calendars in general are always a challenge trying to find the right time. And we will endeavor to try to continue to evolve the program to meet, to be able to serve as many people as possible. So the answer is we will continue to look at that, and if we can, we will. Okay, next question. Is my RMD, my required minimum distribution, designed to empty my pension when I'm in my 90s? So let me try that. So just to remind everybody, the RMD is for a tax-deferred plan like the RPB's 403B. It's designed because eventually the IRS wants its money. So what the IRS says is that once you're no longer working and you're at least 70 and a half, you're required to start taking distributions from plans like ours, IRAs, and the like. The simple answer is that it's designed to continually require a certain amount to come out of your account as long as you're still alive. My understanding is the calculations will never tap it out entirely, but it'll get smaller and smaller and smaller as you get older. So it's not like you're going to run out of money because of the RMD alone. Okay, next question. Let me see here. Someone had a question about Social Security and when is best to take it. To be honest, that's somewhat of a complicated question, and I'm not punting on it to the individual who asked it. It's that there is really a lot to figure out. I'm happy for this individual to contact us separately. We can try to work that through. Or better yet, the Social Security Administration has some very, very good advisors who can help you work through the optimal time to file and to claim your Social Security. I really would advise you contacting them directly. They're the most able to really give you a very specific answer. LifeWorks may also be able to help you as well. So again, don't mean
Michael, may I just add a shortcut where it would be step one. If you're going to start to draw, if the Social Security Administration will tell you that at which age, if you start to draw, and how much money you'll receive, whether it's 50. Let's assume you're going to do it at either 65 or 70. Just hold those two thoughts. They'll tell you what your monthly draw is going to be. So take two columns of paper In the one, start with today's date and mark down every month that you have until 70. So if you're 65, that'd be 5 years, that'd be 60 months that you would be drawing money before at age 70 you would receive it. Now, and add that up. Go to 70. They'll tell you how much you'll get at 70. And then project that down and pick a number, let's say 85. So add up the months. And you'll see in some cases, you made money by taking it early. In most cases, you made money by deferring it. But it's a very easy calculation if you have a calculator and you have a lot of lines on your paper. Start the day at one number, add it up until you start to draw at either one. And again, in our example, 65, you would add 60 columns of, say, $300 a month. At age 70, it would be $500 a month. And then for the next 10 years or 5 years or whatever you want, and you'll see how long it takes to break even. Some people find it astounding, take it early. Others say it's not worth it and take it later. But that's a good step one. So when you talk to the people at Social Security, which unfortunately in my case, both here and trying to have some clients in Israel, the results or the advice can vary a bit. So do your homework. If you don't understand it, don't worry about it. And by all means, do what Michael says. Give him a call. But it's a good step one so you can see where the break even is. There used to be a rule of thumb, but frankly, I forgot it and I don't want to give out bad information.
Okay. Another related question that just came over the transom, and then we'll try to get to the last couple that came in our remaining time, is another way to view Social Security as long-term insurance.
If you can guarantee you're going to have Social Security for the long term, and I'm not trying to be facetious here, but as you well know, there's some talk about putting in an incomes test on Social Security. So please understand that it's not necessarily black and white. It may not help or may not be held against those who are, let's say, 65 and over, but those who are, I don't know the age of the individual asking the question, but I think I would be very careful in predicting how much Social Security you would get depending on your outside income.
Right.
That's what I'm hearing from my people.
Right.
Just make sure you check it out. Sorry, Michael, I didn't mean to interrupt.
No, that's okay. I think one very simple way to think of Social Security, it's a guaranteed annuity. In other words, you get a guaranteed payment, whatever that payment may be. Maybe it's adjusted in the future by certain income limitations, et cetera. But you know you're going to have that income stream for your life, and then of course your spouse, depending upon spousal benefits, et cetera. So that's, I think, one way to think about Social Security. Okay, just in the very couple of minutes we have left, a question came through about market timing. It says, you told us that you timed the market by holding cash at the end of 2018. Now you say do not try to time the market. What gives?
So let me say that this was a decision made by the investment committee, actually a series of decisions made over 3 or 4 meetings in the summer and fall of 2018.
And actually, David, let me stop you. We actually went to, our first cash position was taken in November of 2017.
That long ago, okay, so
yes,
thank you for correcting me.
Yes.
So let me say that the investment committee is involved with juggling a very large number of managers across the 4 managed platforms. And from time to time, we make redispositions from one asset category to another. We don't view it necessarily as market timing so much as redeployment to alternative asset categories that we think are going to do better. If we were getting out of the market altogether and staying there, then I guess that would be more like market timing. I would say that the difference between what we do as a committee and what individuals do is that we're always going to be more or less fully invested. In this case, we held some money back because we felt, technically speaking, that there was a big difference between the value of value equities as opposed to growth equities, and we wanted to take advantage of that difference, and that we recognize might require some weighting, but it was a reasoned policy. We're always cognizant of the danger of market timing, and it's a discussion we have at the investment committee on a continual basis.
Right. And David, isn't it true?
By the way, if I could, Michael, if I could just add, I don't know if we've ever given you the percentage of cash that we used, but I don't want you to think it was 50%. It was 10%. It was done with a trigger that said should the market drop to this level, it would be redeployed. It was discussed every meeting, and it was looked at as an opportunity fund. But the difference, I think, unless I missed the import of the question, if I did, please forgive me, it wasn't where we went 50% in cash. And it was 10% of certain portfolios, not big numbers that I thought your question may have implied. If I'm wrong, please excuse me.
No, Len, you had it right. It was actually just slightly less than 10%. It was up to 7.5% of the capital appreciation fund. At one point or another was put into cash. We did have the trigger, which meant that we actually went back into the market at the very end of December. Once that trigger was hit, we actually redeployed that cash, fully invested back into the market. So as David said and as Len said, that's a little bit different than trying to time the market and guess when something's going to happen. We put those triggers in place well in advance of the decision to go back in. The decision was actually made at the same time we actually went to cash, to be quite honest. So it's now 3:01. I wanted to thank David, of course, and Len for all their contributions and participation, always to Stephanie Berger for helping pull this all together. And thank you to all our participants who really gave us some really good questions for us to really talk about, given where we are in the markets. Look forward to our announcements of our upcoming webinar in the spring. And hopefully we'll have a slightly different story to tell with that. So with that, I will say goodbye, good afternoon, and shalom.
Thanks, everybody.
Shalom, shalom.